Yeah, it was the worst 20-year auction perhaps in history, from the way that I look at it. In fact, I think it is the only the second. Let me put it this way: it maybe the first or the second highest yield for a 20-year bond auction in history. There may have been one other. I read about it an hour or two ago, and it talked about it being over 5%. And I could have sworn it said it was the worst in history, if not the second. And you know, you're witnessing, whether it be here or in Japan or in the UK or all around the world, the bond markets are in very big trouble. I think the concept of owning debt from an insolvent country, one that is irresponsible with their fiscal policy, even in the face of Doge, asking to raise the debt ceiling once again. This is emblematic of what we just saw just the other day, where the Fed had to come in and quietly, in what they call stealth mode, I guess, where they're not calling it QE, bought 43.6 billion worth of treasuries in 1 week, 20 billion in 3 year, 34.8 billion in 10 year, and 8.8 billion in 30 year. The Fed is coming in because no one wants to buy our treasuries at these levels, and you can see it here on the 20-year. That's probably why the market turned around and threw up the way that it did. And you can look at the Japanese market, same thing. You know, I think there is a certain segment of the Japanese population, forget about the unwinding of the Japanese carry trade. I mean, that's very detrimental in and of itself. We saw what happened a month or so ago when rates in Japan first started to move and everything calmed down, but here they are moving up again. And I think one of the reasons you're seeing gold catch a bid is partially because I think there are a lot of traders in Japan who figure the BOJ is going to have to turn around and go back to yield curve control, which should be very, very bullish for gold. But what you see happening here is an interesting phenomena. You know, the Fed is trapped between inflation and keeping rates down. I don't know how they'll do both, but you can see the market perhaps is even stronger than the Federal Reserve. And what's really interesting about all of this is that gold is moving up in the face of rising interest rates. Now, we're always told that rates go higher, gold goes lower, the inverse correlation between the two. But when you factor in what or who's issuing the debt. You know, I was listening to a Bill Fleckenstein interview, and he said, you know, on Wall Street, we used to call that a who-to problem. Who do we sell it to? And I think that's the issue, is that, you know, we're finding a pool of a diminishing pool of interested parties to buy our treasuries. And it's funny, you see China, who is now slid to number 3 in treasury holdings, replaced by the United Kingdom. Vince Lancy had a great analogy. He said it's like two drunk guys holding each other up from falling. You have, you know, the largest debtor nation buying debt or selling its debt to the second largest debtor nation, or real darn close to it anyway. So two broke nations buying each other's debt, as the rest of the world seems to be favoring things like commodities and cryptocurrencies or whatever the heck they can get their hands on that are tangible, copper or silver, gold or platinum, which we saw a microcosm of a short squeeze yesterday and a little bit today. And I think that's on a larger scale what you could expect to see in the silver market. But yeah, it's an interesting time right now. And certainly I think it focuses squarely on the bond market. That's where really the trouble lies.
You know, when you see something like what just happened in the 20-year bond auction, a total disaster by historical standards, it really makes you stop and ask, how much longer can the illusion of stability last? I mean, we just witnessed arguably the worst 20-year auction in US history. Maybe it ties with one other time, but this was brutal. We're talking yields over 5%, which tells you something very simple. The market doesn't trust US debt, and that's not a small thing. That's a foundational crack in the system. There's a reason why markets turned on a dime and puked when that auction hit. Because this wasn't just a bad auction, it was a referendum, a signal, and it was loud and clear. The world doesn't want our paper anymore, at least not at these rates. And sure enough, just days later, the Fed comes in quietly, stealth mode they call it, and starts buying again. They don't call it QE, of course. That would admit that they're backstopping a failed bond market. No, they're maintaining balance sheet operations, or some other euphemism. But the fact is, They bought $43.6 billion in treasuries in a single week, $20 billion in 3 years, $14.8 billion in 10 years, and nearly $9 billion in 30 years. Now, I don't know what you want to call it, but when the buyer of last resort is now the buyer of first and only resort, that's not a functioning market. That's a shell game. And here's where it gets scary. This isn't isolated. You're seeing the same dysfunction across the globe, in Japan, in the UK, and the EU. The bond markets are in real trouble because no one wants to hold debt from governments that are broke and getting broker. The central banks are trying to put out fires with gasoline. Japan's a great example. Everyone talks about the carry trade, the idea that investors borrow in yen and invest in higher-yielding U.S. assets. But what happens when Japanese rates start creeping up? What happens when the BOJ can't keep yield curve control going without imploding their currency? We saw a glimpse of it just a month or so ago when Japanese rates moved and markets globally panicked. And now they're starting to move again. And I think a big part of why gold is suddenly catching a bid is because people see this trap forming. They see central banks stuck between a rock and a hard place. You can either let rates rise and crash the bond market, or you intervene and destroy your currency. Either way, something breaks. And people are betting, wisely I think, that gold wins in that scenario. Traditionally, we're told that rising interest rates are bad for gold, that there's this inverse correlation. But what happens when rates are rising and gold rises anyway? That's not supposed to happen, unless the market is losing faith in the debt itself. Unless the rise in rates is a sign of risk, not health. And that's exactly what we're seeing. It's not the cost of capital that's worrying people, it's the solvency of the issuers. I was listening to Bill Fleckenstein recently, and he made a great point. He said on Wall Street, when things got hairy, we'd always ask, who's the buyer? And right now, that's the trillion-dollar question. Who wants this debt? China? Nope. They've dropped to number 3 in treasury holdings. Japan? Maybe, but they've got their own crisis brewing. The UK, sure. If you believe two broke countries can hold each other up like two drunk guys at a wedding, there was a great quote I saw from Vince Lancy. He said, "You've got the biggest debtor nation selling debt to the second biggest debtor nation." I mean, if that's not a recipe for disaster, I don't know what is. It's a magic trick, and the rest of the world is done clapping. Instead, they're moving to what's real: commodities, cryptocurrencies, physical goods, anything tangible. Copper, silver, gold, platinum. We even saw a little short squeeze in platinum this week. You think that's a coincidence? It's not. It's a sign. And I think what we saw there is just a microcosm of what we're going to see in silver when this thing breaks wide open. And this is where I get a little animated, because I don't think people understand the depth of the problem. We are witnessing the slow-motion breakdown of the greatest financial bubble in history, the sovereign debt bubble. And it's happening at the core of the system, not in subprime loans, not in exotic derivatives. No, this time it's in treasuries, the so-called risk-free asset, the one that underpins everything: bank collateral, pension funds, insurance portfolios, global reserves. And now that risk-free asset is down 50% in price in some maturities. That's a bear market. That's a confidence crisis. And there's no easy way out of it. The Fed is trapped. They can't keep rates high without bankrupting the government. They can't lower rates without reigniting inflation. So what do? They buy quietly, stealthily, desperately.
I don't know why they decided to do it now, right when you have an administration actually addressing the irresponsibility and the corruption in basically the evisceration of our currency through ridiculously irresponsible programs that the government has spent our money on. Now they want to do it, not before this. I think Moody's is kind of nonsense, to be honest with you. But they talk about a warning of a debt to GDP hitting 134 by 2035. But the truth of it is, if we add in the unfunded liabilities, we're well north of 200. And they say an interest burden will consume 30% of the revenue by 2035. Up from 9% in 2021. Well, the Congressional Budget Office also said by 2031, every penny of tax revenue will go just to pay the interest on the debt and these mandatory off-balance sheet entitlements Social Security and Medicare as an example. So anything that's discretionary, like military, which is $1 trillion bill this year, will be borrowed. And at what point do we realize that the world has lost appetite for the treasury? So who's going to buy it? It's that who to problem again. Who are you going to sell it to? And when you see the Fed come in and not even admit the fact that it is quantitative easing, that they are buying treasuries, and they do that, they're trying to plug a hole in the dike to keep the bond market together and to keep this from accelerating. But this is a real problem. At some point, the irresponsibility catches up with you. At some point, the way that we behave on the international stage, the tariffs, the threats, the sanctions, the spending, the borrowing, the raising of the debt ceiling, on and on and on. At some point, I think the attractiveness of our debt looks silly, and anyone who would hold duration of any length greater than 6 months or less, I think is a fool in this market right now, and the bond market is proving that to be true. And again, it's really interesting that as rates are going up, so too is gold. Gibson's paradox speaks to the inverse relationship between real rates and the price of gold. And as rates continue to rise, even if we have to suspend the fact that we know that the CPI is a bunch of crap, but let's just take it at face value. That's what the market uses. Well, as the rates right now are certainly over the CPI, that is a return, a real return. One would expect that gold, which does not pay a real return, should be retreating. And one of the hallmarks of this market that is vastly different, Dunnigan, than anything I've seen in 35 years is, it's kind of like a fight in high school where, you hit the kid, he never gets back up. You're watching two kids fight. One hits him, he never gets back up. But this time the kid keeps getting back up. He gets hit and he gets back up. He gets hit and he gets back up. And I've never seen that before. Maybe that's a bad analogy. But the point of it is that it never did this. It would get hit and it would be down for years and sometimes even longer than that. And you look at 2011 when it hit $1,900 and it was down for a long time. 8 years or so, 7, 8 years before it finally came back. And but this time seems to be different. It goes down $100 or $200 and comes right back up. And the demand in Asia is overwhelming. And you can see it. It's almost as if the Chinese now are controlling the price of gold.
Let's get right into it, because this next part isn't hypothetical anymore. It's happening in real time in front of our eyes. The great global rebalancing is underway. The BRICS nations, Brazil, Russia, India, China, South Africa, and now with new members knocking on the door, are no longer whispering about de-dollarization. They're building the infrastructure for it: gold accumulation, bilateral trade in local currencies, alternative settlement networks. The US dollar's role as the global reserve is being quietly but deliberately chipped away. And here's the kicker: they're not doing it by launching some flashy new currency overnight. They're doing it methodically, through action, not announcement. Russia and China are settling oil and gas contracts in yuan. India is buying gold at a record pace. Saudi Arabia is taking steps to accept non-dollar payment for crude. And all the while, the West pretends this is fringe, that it's just talk. Folks, it's not talk. It's happening. The world is voting with their reserves, and they're voting against US treasuries. You know how I know this is real? Because it's not just what they're doing, it's what they're not doing. China isn't buying our debt anymore. In fact, they're selling. They've dropped to the third largest holder of US treasuries, behind the UK, which probably holds half of those on behalf of someone else anyway. Think about that. The largest economy in Asia, the main buyer of our debt for 20 years, is walking away. That's not a trade. That's a regime change. And as that demand disappears, who steps in to fill the gap? The Federal Reserve. Stealth QE liquidity injections, repo operations. They'll dress it up however they need to, but the result is the same: monetizing the debt. Just like the Weimar Republic, just like Argentina, just like every empire in decline that tried to fund dysfunction with a printing press. This is why gold is moving in a way that breaks traditional models. For decades, people would say, interest rates are rising, gold must go down. But not anymore, because now rising rates don't signal strength, they signal stress. Stress on the system, stress on budgets, stress on confidence. That's why gold's catching a bid even with rates over 5%. It's not a reaction to policy, it's a reaction to instability. And that brings me to silver. Silver is like gold's angry little brother. It waits, it simmers, it frustrates you. Then when you've nearly given up, it explodes. We've seen it before, in 1979 and 2011, and I believe we're going to see it again. But this time, the setup is even more compelling. First, let's look at the fundamentals. The Silver Institute reports global silver demand exceeded supply again last year. Industrial use is exploding. Solar panels, electric vehicles, batteries, medical devices, you name it. We are entering a green revolution, whether you agree with the politics of it or not. And silver is the key metal behind the curtain. You don't get solar or EVs or smart grids without it. And yet, despite this surge in demand, global inventories are shrinking. The COMEX registered category is a fraction of what it was just a few years ago. LBMA stocks are falling. Industrial users are starting to hoard. And the miners? They're not producing more. In fact, silver mine output is barely growing at all, and most of it still comes as a byproduct of other metals. But here's the real powder keg, the paper market. The silver price you see every day, that's not based on actual supply and demand. It's based on derivatives, on futures, on unallocated contracts, on promises, not ounces. And that's where this gets dangerous, because the moment just a fraction of those paper holders ask for delivery, when people stop treating silver like a trading vehicle and start treating it like a monetary asset, the whole thing implodes. There isn't enough metal, not even close, and when the squeeze comes, it'll make GameStop look like child's play. This isn't speculation. This is arithmetic. If everyone who holds paper silver on the COMEX tried to stand for delivery, the system would freeze. You'd see cash settlement offers, margin hikes, force majeure, and silver wouldn't go to $30 or $40. It would gap to $100 and beyond. Not in months, in days. And what's crazy is, the public still doesn't see it. They're still playing in tech stocks, still listening to CNBC, still thinking the Fed has it all under control. But meanwhile, the central banks are buying gold in record quantities. The BRICS are building a new monetary system. Silver is quietly draining out of vaults. And the Western investor? Still asleep. Let me give you a little perspective. Back in the 1970s, when the US dollar lost 75% of its purchasing power, gold went up 30-fold. Silver went up 35-fold. And this wasn't during a total collapse. This was during a transitional period. Now fast forward to today. The debt is 10 times bigger. The deficits are permanent. The entitlements are politically untouchable. And the population has been trained to believe inflation is normal. You think gold and silver won't respond to that? Now, I'm not saying silver is going to $500 tomorrow, but I am saying the conditions for a violent repricing are already in place. All it takes is a trigger, a failed bond auction, a banking hiccup, a geopolitical flashpoint, anything that breaks the illusion of control. When that moment comes, silver won't knock. It'll kick the door in. So what do? You prepare, not with paper, with physical metal, real ounces, in your hand or in a vault you can trust, not in a digital certificate, not in an ETF, not on some app on your phone. This is about control, because when systems fail, custody matters. You think the banks are going to prioritize your unallocated claim when they're under stress? Think again. And you don't just buy the metal, you understand the system. You educate yourself, because knowledge is leverage. When everyone else is panicking, your calm comes from preparation. When others are paralyzed, you're executing. I said in part 1 that this is not just a market correction, it's a monetary transformation. The dollar isn't going to zero tomorrow, but it is going to lose purchasing power every year as far as the eye can see. That's the plan. That's the only politically viable way out of this debt trap. And gold and silver will reflect that deterioration. Not perfectly, not linearly, but inevitably. And look, I'm not here to sell fear. I'm here to sell clarity. If you've made it this far, you already sense something's wrong. You feel the disconnect between the headlines and your grocery bill, between what the Fed says and what your savings account earns. You don't need a PhD in economics. You need common sense. And common sense says this system is stretched, fragile, and fundamentally unsustainable. So you get ahead of it. You own metal. You stay liquid. You exit the system where it makes sense. And you wait. Not for a crash, but for the inevitable revaluation of what's real versus what's paper. And when that happens, you'll be on the right side. Not because you guessed, but because you saw, understood, and acted. I'll leave you with this. We're not just in a financial shift. We're in a generational one. What worked for the past 40 years won't work for the next 10. Bonds won't save you. Fiat won't protect you. Diversification won't matter if everything's correlated to a broken denominator. In this environment, wealth isn't preserved by strategies, it's preserved by substance. So get out of the illusion, get into what's real, and get ready for the biggest wealth transfer of our lifetime.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.